Hello once again. My name is Elliot Harris and I'm the chair of UK Business Advisors Financial Solutions. And I'm here with my colleague Richard Olsen, and Richard's been talking to us about funding for your business. The first video was on mergers and acquisitions, and today he's going to be talking about working capital solutions. So once again, Richard, thank you for doing this, and over to you.
Thank you, Elliot. It said we were talking about working capital solutions, so let's move on. There are 5 primary sources of funding available to you. Invoice discounting and factoring, stock finance, trade finance, supplier payment finance, and commercial loans. So if I look at invoice discounting and factoring to start off with, traditionally, invoice discounting was always very much considered the big banks would come in, they'd look at the whole of your debtor book and they'd offer you terms based on it. And they were multi-year deals. Over time, that has all changed. Confidential invoice discounting has come about. So the invoice discounting is no longer disclosed. It can still be disclosed, but it's generally something you can request for it to be confidential now. The advent of single invoice discounting has come about, which allows you to, for example, you get a large order in, which is unusual for your business. You know, we've had examples where businesses have got a £300,000 order at a time, and they typically only deal in the tens of thousands. Well, they can fund the tens of thousands of sales deals. What they can't fund is something that's 20 times the size. So they go and get themselves invoice discounting. Selective invoice discounting is where you actually choose which of your customers you're actually going to use invoice discounting for. For example, if you've got customers who pay regularly on the nose, or for whatever reason you want to exclude them, you can do. So it's up to you how you set up your facility. The advances you can get in invoice discounting range from anything from, say, 50–55% for construction sector through to 90% for recruitment. And there are instances where you actually can get 100% invoice discounting as well. So you get 100% advance on it. Rates, interest rates, anything from, say, 2.75% over base through to 4.5% over base, depending on the value of the turnover of the business. And administration fees, probably at the lower end, 0.3, 0.35, and at the higher end, up to, say, 2 or 3% per month. Again, depending on the actual turnover of the business. And there are lenders now who offer minimal notice periods, so it's just a rolling 3 or 6 month period. There's no long-term contractual agreements. There's some of the lenders will also have no minimum administration fees a month, so if you don't use it in 1 month, it doesn't cost you anything, whereas others will choose a minimum fee. But there's a whole series of questions, and we typically ask every single lender who quotes invoice discounting for us 34 different questions in terms of actually being able to compare apples with apples and ensure that when we get competitive prices in, we can actually compare them correctly and give you an informed decision. Stock finance, primarily focused around retail, tends to be around fast moving goods, and it makes more sense around fast moving goods when you imagine that rates are in the region of 3% per month. You can't afford for stock to just be sat there doing nothing. You want to be in a marketplace where you have seasonal demand, or it's an instance of the stock is constantly moving to make it worthwhile to take on stock finance, but it is a funding solution available. Trade finance. Trade finance, obviously extremely important at the moment, especially with businesses now who already exported to the EU, now having to fund additional costs such as increased transport costs and VAT factors in the EU member states. We're seeing this quite a bit. But ultimately, trade finance is all about having a confirmed purchase order from a client. So it doesn't work for speculative work where you're trying to fund something that you might sell in the future. It works where you have confirmed orders from a client. Say a large company is supplying you with a purchase order, and you can document it all the way through to your invoice being received from your supplier with a purchase order to match it and all the bank transactions. Trade finance are looking to see the regularity and the confirmation that you actually know what you're doing in terms of the whole trade cycle. But again, it's another expensive form of funding. It is in the region of 3% per month. But again, you shouldn't be holding this finance for a long period of time. And trade finances like to work quite closely with invoice discounters, because effectively when the product arrives, say, into the UK, and you sell it to XYZ company, you can literally take out the trade finance company by using invoice discounting to pay off their loan or their lending on that particular transaction. So it seems to work quite well in that regard. Supplier payment finance, if you could think of this as almost reverse invoice discounting, it's actually going the other way down the supply chain. So it encourages you to pay your suppliers earlier to get a discount. So you're funding that gap. And by funding that gap, there's hopefully enough of a margin by the discount you get from your suppliers by paying early that it actually funds the interest and the administration fees actually on the money that you're borrowing. So it is a way that you can help your supply chain become more efficient for you and actually improve your margins as a business. Then we have commercial loans. Commercial loans obviously split into secured and unsecured. Secured is anything against which a loan is taken and secured against a asset such as property. You could argue that invoice discounting is a secured asset because it's secured against the debtor book, plant and machinery. So those are examples of secured loans. Unsecured are generally supported by personal guarantees, and you would see most of those loans being typically in the region up to about £500,000. Where they're unsecured, there's no requirement for any form of security other than the personal guarantee. Talking personal guarantees, it's worth pointing out that generally when you're dealing with alternative lenders, the likes of the peer-to-peer marketplaces, they generally expect you to give 100% personal guarantee in the of the loan amount. And for the high street banks, there can be a bit more negotiation around that. If I just go back up to invoice discounting, something I should have mentioned is that invariably with invoice discounting, although it's secured against the debtor book, there is a requirement to give a personal guarantee. And the personal guarantee is an element of negotiation there between you and the lender. But you would expect to typically have a personal guarantee in the region of, say, 10% of the value of the facility itself. Last point to bring up, it's a very worthwhile point, is that personal guarantee insurance is available for these PGs that you may have to give. I will go into this in our next video, but in essence, it starts at 80%, or sorry, it starts at 60% and goes up to 80% in year 3, but it is a way of protecting yourself in the unlikely event that your business should fail.
On the subject of the different types of lending, you mentioned stock. Now, presumably, there are only certain types of industries that stock lending is valid for. So, for example, manufacturing and work in progress doesn't lend itself to stock finance. Would that be true?
We can use stock finance in manufacturing. It's harder, but definitely a work in progress, no, because unfortunately it's moved between that place which is stock into a place which is no longer stock and actually it probably is being made for a purpose. So unfortunately not for work in progress.
And just the other thing to touch on, the commercial loans versus the peer-to-peer sector, there are pluses and minuses with both, aren't there?
Yeah, definitely. Generally with peer-to-peer sector, we've got situations with speed of application, less information, quicker money in your accounts versus higher interest rates, higher admin fees. High street banks, they will take longer, they want more information. However, they will give you better terms in terms of rates and lower admin fees. So there are, pros and cons, but it depends on what your situation is and how urgent the need is for money.
Yeah.
Just probably something I will keep repeating throughout our presentations is that you need to understand the marketplace. You need to understand what's available for a B2B environment, and that's primarily what I've walked through there, is what's available in the B2B environment. What's available in the B2C environment, because by its very nature, you won't have an invoice discounting facility available in the B2C world because there's no lender out there who wants to get involved in lending money to, who wants to lend money to a company who has invoices outstanding to consumers because they're worried about the reputational risk. Stock finance, we've said, is a potential solution for the B2C environment because of the nature of the beast. Trade finance is unlikely to be a solution there. supplier payment finance might be a solution. It might be possible. So, yeah, and a commercial loan is definitely available to a B2C business, but you need to understand what's actually potentially available to you. You have to understand what the tricks are the funders get up to, know to ask the right questions, and put funders into competition. Because if you just rely on going out and getting the first set of terms, you're not necessarily going to know if that's good, bad, or indifferent. It may take more work, and that's hence why Pegasus exists as a company, is to ensure we get the best terms available for you as a client. And the final point is that high street banks will usually be the cheapest, not always, but usually. They just take a lot more work. If you think about it, if you can get an application in with a funder on a peer-to-peer platform and get it all sorted, resolved in a week or less, with just uploading your accounts and bank statements and maybe one other piece of information, versus a bank which might take you 1 to 2 months to do, that's your decision to make as to how important it is. But with careful planning, proper analysis, it should ensure that you actually end up in the right position.
Well, thanks for that, Richard. We've had you on 2 things now, with mergers and acquisitions and cash flow and working capital. And so our next video, you're going to be talking about personal guarantee insurance and giving us some more information. So thank you very much, and we'll see you next time.
Thanks, Elliot.